All right, welcome back to another episode of Paladin Financial Talk. This is Nikki Foley, and I am with the one and only Mr. Jeff Foley today.
Woohoo! Yeah, a couple weeks ago we had two Jeffs in the studio. Today, two Foleys.
There we go. Fantastic.
Yes.
We haven't done a show together for quite some time. I mean, like maybe a couple years since we've done a show together.
It's been that long. Oh.
Well, today is our final episode of One Big Beautiful Bill Act. Whew, it is a mouthful. What is the acronym on this? It's OBA.
OBA.
But not ABBA.
Not ABBA. Not the 70s band that I'm sure everyone listening knows and loves.
Well, fantastic. So we have spent the last 4 weeks talking about One Big Beautiful Bill, and this time we're going to be future thinking, and we're going to talk about some of the changes related to estate taxes, charitable giving, the new children's accounts that have been introduced, and just some of the tax credits that are on their way out. So with that in mind, Jeff, I'm going to let you kick us off here because you have been working with each of the advisors and talking through some of the changes. So just get us started on this one as well.
Yeah. So the first one up to bat here is the federal estate tax exemption. So there were increases that were put into place with the 2017 Tax Cut and Jobs Act, and those have been made permanent, where we have an increase in the federal and estate and gift tax exemption. So in 2026 and going forward, until someone changes it again, the exemption rises to $15 million per person and $30 million per married couple, and that number is going to be indexed for inflation. So we'll see what that increases to over time. So that means that families can inherit up to that amount and not have to pay federal estate taxes. But you have to keep in mind that depending on the state that you live in, we're here in Minnesota, state taxes kick in at a much lower bar of $3 million, and those range from 13 to 16%. So it doesn't take all that much to get over that needle, and your estate rather, is paying 13% at a minimum in estate taxes. So this creates some opportunities for families that have potential liquidity issues. You think of farm families that have built the farm over the years and they're land rich, but they're cash poor. Family that owns it passes away, that could create definitely a liquidity issue for a lot of people out there. But raising that up to 15 and 30 million creates a lot of breathing room for families, and it also gives them more time to plan ahead and look at different things: succession plans, conservation easements, family limited partnerships, other tax planning techniques that can be used to get around or appropriately get around the estate tax. So that's a big one people want to be aware of.
So the next one that I want to talk about is the charitable giving side of things. And, as you talked about some of those numbers, some people might be like, oh, that's not applicable. Well, this one is probably applicable to a lot of families and a lot of people along the way. And everything I'm about ready to go over is effective for 2026. And so it's nice to point out so that we know it's not all the same in this bill. Some of them are immediate, some of them are 2026. And so these next items are for 2026. And so it allows non-itemized taxpayers to claim a deduction of up to $1,000 or $2,000 for couples beginning in 2026. And this provision is permanent. So what does that mean, or what does this look like? So extending this deduction opportunity to non-itemized will likely result in more people donating to charitable organizations. And so what does this mean? Contributions must be made in cash to a public charity, and there is no income phase out. So this means that it's applicable to a very wide range of people that are wanting to make those type of charitable contributions. Another piece that goes into this is for those, so that was non-itemized, but for taxpayers who do itemize, there's a new floor in place. And so this is established for charitable contributions, meaning that only the amount exceeding 0.5% of their adjusted gross income is deductible. So I'm so much better on examples when you start getting into some of these numbers, that if your AGI is 300,000, well, this means the first 1,500 of your charitable giving doesn't even count towards this deduction. So you can only deduct anything beyond that amount. And again, this is effective for 2026. And so again, something for non-itemized taxpayers, something for itemized taxpayers. And then there's also a new limit for those in the top tax bracket, which effectively limits the benefit to 35%. So what does that mean? Again, going back to the examples here, that for charitable givers in the top tax bracket of 37%, the benefit of itemized deductions is capped at 35%. So rather than, if you were making a donation of $1,000, rather than getting 37%, you're in fact getting 35%, which in this case would be a $350 deduction.
Which is a brain bender.
It is. I did have to like stop and read and think. And that's what, on some of these, we just want to bring to life what is really happening and what is the layman's terms on some of this. So hopefully it's making sense so far, and these have been helpful along the way we spent the last 4 weeks going through some of this. So action steps in this category: if you itemize, discuss any of these changes with your tax professionals so you know how to best proceed with charitable donations in 2026. And if you don't itemize, this really opens up an opportunity for you and the option to claim this deduction in 2026.
Yeah. As you mentioned, this might create, for some people that are non-itemizers, some people might donate more, but also creates an opportunity for people that are donating that they can pick up that deduction even if they aren't itemizing up to those limits. So it's a little bit of a savings there.
Yeah.
The next area we'll talk about is the child savings accounts. We've touched on these briefly in the overview episode, but the new Trump accounts, of course, they're called. I think when you open the account, I'm curious if there's a gold label on the account.
Shiny gold.
Stick with the Trump theme there. But it's a new type of custodial investment account that parents can contribute to, and this includes, depending on when your child was born, between January 1st of 2025 and through the end of 2028. Any newborns during that period of time will also be eligible for $1,000 out of the government's pocket to kind of seed that account. And then in addition, parents can add up to $5,000 a year up until the year that the child turns 18. So if your child turns 18 in May of that year, you're going to be aware of the timing of the limits with that. You can open it up for someone that's under age 18 and outside of that birth window, but you're not going to, again, receive that $1,000 government credit. Contributions are not tax deductible, and you want to be aware of that. The money is going to grow tax-free until it's withdrawn. Does have to be invested in a broad US-based stock market index. No surprise there. And account holders, once they get to age 18, if they pull that money out for what it's called qualified purposes, and there's a definition for that. So things like paying for college, starting a business, buying a first home, basically, you're going to have some tax benefits. So once that money is cashed out, distributions are going to be taxed as long-term capital gains. If it's a qualifying purpose, money on anything else would be taxed as ordinary income. So again, incentivizing youth to start out on the right foot. And overall, it's a lot less generous than putting money into a 529 plan for higher education or even K through 12 expenses and even a Roth IRA. So I do see there's probably some limits on how people are going to use these. I think there's more fanfare here than financial impact, but for lower income households, getting that $1,000 and being able to open up that account and get started off early, the power of compounding is tremendous over time. So you want to consider, depending on your options, what you're planning for your child. Do you plan on them going to college or not? You plan ahead, but a lot of people, I think, are going to continue to fund 529s more heavily than this type of account.
That was good, Jeff. So the next one I actually have heard quite a bit of chatter about, and it's the green energy and student loan break green energy credits. So we're talking about the green side of things here. And again, this is one that has come up just in casual conversation, I feel like, quite a bit. And so there's 2 points that you want to know as it relates to this side. The bill winds down most of the tax credits that were approved by Congress in 2022 as part of the Inflation Reduction Act. So the current $7,500 tax credit for the purchase of an electric vehicle, for example, will be eliminated for vehicles purchased after September 30th of 2025. So this one specifically is pretty immediate. And then also the residential clean energy tax credit is gone after 2025 as well. So things like rooftop solar, geothermal, anything like that you're thinking about, now is the time. So again, taking action on things, both of these are pretty immediate and winding down at the end of 2025 or the one with the electric vehicle September 30th of 2025.
Yeah, green is gone in essence with that. The next one we'll talk about is student loans. So the new bill scraps the current repayment plan, stretches out the forgiveness timeline, also ends funding for graduate plus loans, and there's also a new lifetime borrowing limit for graduation students. So if you know someone, they're continuing to go to school, they're trying to get that graduate degree, there are going to be some limits on that depending on the type of school that they're going to and how much they can borrow over time.
And the Medicaid work requirement, this one will be interesting, and we'll probably see more about this one, I anticipate. But if you are a childless adult or a parent with kids who are 15 or older, you'll need to prove that you worked, volunteered, or went to school at least 80 hours the previous month to qualify. So this is certainly something that's going to impact some of the families and people that you may know. So the eligibility checks are getting stricter because states must now verify eligibility every 6 months. So this is a system that's already one where people have to wait. It's hard to get service and making sure that you're getting answers. And so we'll certainly probably hear more about this and some of the constraints that are coming along with it.
Yeah, and very mixed emotions from people. Some people are proponents of this, and for others, there are going to be people that lose out on some of these benefits. So that 80 hours, that's basically working half the month, proving that you did that. So finalizing things, looking at some next steps that you can do, as we've talked about in the previous episodes. You want to look out your multi-year tax plan. Some of these provisions, as we've talked about, are temporary, some are permanent, some, as Nikki pointed out, start this year, next year, et cetera. So put those key dates on a calendar. I would recommend have your tax folder. We have a tax folder at home, as throughout the years we have donations and things, receipts. We'll put in that folder. As keep a little checklist in there of the relevant provisions, their timelines, and how that might relate to you. So if you're doing your own taxes, you can look those up or remind your tax professional of, hey, I want to make sure that we work this into our tax plan. You also want to look at your charitable giving plans, and depending on whether you itemize or don't itemize, deductions, Roth conversions. Roth conversions just got a lot more complicated for a lot of people because of the moving parts within the OBBBA. And then coordinate strategy. So you want to work with your advisor, your financial advisor, your CPA, your estate planning attorney, depending on the complexity of all of your moving parts, and make sure you've got a well thought out integrated plan. Mark for expiration dates, so not only the start dates, but the expiration dates, and stay flexible. They're going to be, the bill was 900 some pages, but there's still a lot of unknowns that they'll come back and make edits to, some technical corrections, state level integration that need to be worked into that. So stay flexible and pay attention to that. And then continue to tune into Paladin Financial Talk in the coming weeks as we dig into some of these provisions and edits as those become available for us. So those are a few items for people to think about with the One Big Beautiful Bill. If you're listening to this episode, you can go back. This is our 4th episode on the new act. And in the previous ones, we broke down some of the more detailed provisions of this. As always, please take a moment to swipe down as you're listening to the podcast and give us a rating. We would truly appreciate that. It does help make the show more available to other people. And as always, send us questions. If you have anything you want to make sure that we cover in the show, you can email us at info@paladinfinancial.com. Give us a call. Our number is 651-842-8406. Or you can visit us online at paladinfinancial.com. And from Nikki and I and the whole Paladin Financial crew, thank you, and wish you a wonderful week.